This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Abaroa. Al is Chief Investment Strategist, Trading and Portfolios with Kingsview. Al has been a registered broker and trader since 1993. He has seen all aspects of the investing industry. Today, we're going to talk about a white paper that Al put together about trend following. Quite interesting. I think you'll enjoy. For those new to trend following, something to learn. And for those of you very familiar with trend following, I think Al has put together an interesting piece. Please enjoy. Hey, so I was just thinking, we last saw each other at Searsucker in San Diego. That would be a restaurant for those listening. Is that a fair memory?
That is a fair memory and a great restaurant, by the way.
It is. I actually grabbed lunch there in January before I ventured back off to the farther east. So yeah, it's a nice place.
How's Asia?
No complaints. So far this year, I've been in Singapore and Vietnam. I'm sure I will be some other places soon enough. You know, it's real. I think the interesting thing about it is that it starts to just become another city. So, you know, you're in South Florida, you know what it's like to go to San Diego. It feels just like normal. I think that's what's happened for me. Okay, going to Singapore, it just feels like another city, you know?
I have yet to visit Singapore, and I'm hoping that your conference comes to fruition in the fall, as I will certainly be in attendance to that.
Hey, listen, let me jump right in. So you've got a cool white paper out, and I want to get into that. There's a lot of different thoughts. And when I was going through everything today, I was like, wow, okay, my conversation with Al is going to be like breaking. You know, I've had some interesting conversations in the last couple of weeks. Nobel Prize winner talking about behavioral finance. Ed Sakota talking about his new book, but not really trend following. So today, with your white paper, we're going right into trend following. There's no doubt about where our conversation is going. And as I was thinking about it today, as we look at equity markets at generally all-time highs, I think people have forgotten that anything can and does happen. Has that kind of gotten lost again in the last 4 or 5, 6 years?
I think that you're seeing some very optimistic behavior in the markets. And I'm not here to predict. I'm not a predictor, as most trend followers are not predictors, but rather participants with what's happening. But when you see patterns that are out there, people levering themselves up on margin. I mean, we have some of the highest margin rates out there right now. You see stocks that are becoming very frothy, just running to new highs without any earnings backing that up. That gets people nervous. So it should get people nervous, but it doesn't, interestingly enough.
I couldn't help but think when I saw that WhatsApp acquisition by Facebook, it kind of reminded me of AOL buying Time Warner with funny money stock back in the day. Now, I have no earthly idea what that means. I'm just saying, hey, it kind of reminds me of the same thing.
I can see the similarities for sure. I mean, they had, maybe, I don't know what the revenues were, but it pales in comparison to the $19 billion acquisition price.
Yeah, we all got to have to dream up the newest version of an instant messenger that will attract the world's attention for 5 minutes. Well, hey, let's move back into trend following though. You've got something very simple that I've seen in your writings, and you just say it's your wealth formula. I mean, it's very simple sounding, but I wonder if you could just repeat that, because I think we get lost and we like to make things more complicated than they perhaps are.
The wealth formula is, I would love to say that it's an original thought. I think what's original about it is the simplicity of which we try to deliver the message. At the end of the day, we have certain dollars that we're all trying to grow. The way that we grow those dollars is based on a very simple premise, which is the concept of reasonable return the compounding of that reasonable return over as much time as we can throw at that equation. So if we have 10 years or 20 years or whatever that case can be, this is what's going to ultimately generate our end result, the wealth number. Now, when you drill down into that wealth formula, you kind of have to think about where you can tweak the variables. So we have the reasonable return category and we have time. Compounding is static. We're not going to change that. We're either going to compound or we're not. So if we look at the time category, well, for those that have started early, they've got a little bit of an advantage in that time model. But for, let's say, a person who's in their 50s or even 60s that needs to play some catch up, well, guess what? You can't arbitrarily add 10 more years to your life if you decide you need more money. So the only place that we can really focus on that wealth formula is in the reasonable return category and attempting to increase that reasonable return category to hopefully end up with a higher wealth answer.
But we all know increasing reasonable return, ultimately, it's two sides of the same coin. You want greater return, you're going to take some greater risk, aren't you?
Oh, without question. What's interesting, though, if you focus on the reasonable return category, the traditional financial advisory model has always been based on the long-term outlook of the market. And while we agree that the long-term outlook is something to pay attention to, I think that we have to drill down one step further, which is really looking at how to capture price movement. If we were to go back and look at the equity markets, whether it's the Dow Jones or the S&P 500, and we kind of go back as far back in history as we can, we're going to find that the market growth rate is roughly, 6, maybe at best 7%. Now, that takes into consideration that you never sell stock, that you reinvest your dividends, and that you hold this for the long term. If you think about it, markets do three things. They go up, they go down, and most of the time they go sideways. So focus on price action in an effort to increase the reasonable return category, which is what trend followers do.
Let me jump back to one thing you mentioned, though. You were talking about somebody in their 50s or 60s. And I don't think you and I have any problem being very frank about the problems that investors in their 50s and 60s face today. The punch bowl in terms of income has been taken away, and it doesn't look like it's ever going to reappear again. And, it's a really tough thing to tell people in their 50s and 60s, like, hey, you might need to consider some higher risk and higher return type investments just to get you through retirement. But you know what? I think if you and I are having this conversation right now about that very issue, I think most other people in the industry are being dishonest because they're not having it. They're just pretending that there's just going to be this fairy that's going to come along and produce all this wealth.
Listen, I couldn't agree with you more on that subject. First off, in my opinion, the thought process of 50 and 60-year-old model was based on 30 years ago. 20 years ago. Life expectancy is far greater today than it was 20 or 30 years ago. So when you're 60 years old, you're now planning hopefully for 80, 90 years old in lifespan. Like you said, the benefits of which people were expecting, whether it's pensions or, Social Security, which may evaporate one day altogether, kind of leaves all of us on our own to fend for ourselves. In turn, that wealth formula becomes even more important today than it's ever been.
Do you think it's a fair proposition that, this might sound dire, but if people just look at the numbers, it looks clearly like governments are eventually going to go to negative interest rates. Yes, that means you will pay them to safely get back 98% of your money at the end of every year. But I almost wonder if people should just stop worrying so much about it, make the right decisions. And you know what? If the chips don't fall like they should during your lifetime, maybe you've just done well for the kids in their lifetime. It's a brutal thing to say, but you're right. We've got to fend for ourselves and our family and friends, don't we?
I agree. And by the way, for us to spend a lot of time thinking about the politics that are going to govern our economics, and when I say our, I mean government, not necessarily you and I individually or the listeners. We can't control that. There's nothing that we can do about that. So I don't think that there's a lot of time and effort that needs to go into thinking about those policies, but rather trying to figure out our own kitchen table economics, looking at what we need to do, how our budgets, personally, you, me, the listeners, and how we're going to finance that with our own personal wealth.
So hold on now. Are you telling me that people actually got to do some heavy lifting and some heavy thinking, so to speak? And you mean the cable news shows aren't going to help us make money?
Yeah, the sad story is that we're actually going to have to do some work here. That's a fact.
Okay, let me jump in here. So one of the things you did in your white paper, Global Volatility Index. And there's a couple different areas that you go in your white paper illuminating aspects of trend following that I think are important. One of the reasons we are having this conversation is you brought up something that Tom Basso had brought up in a podcast. And before I jump into the white paper, I wanted to let you expand on that because Tom was talking about black swan events. But I think you wanted to add some more to where he was going.
Yeah, first off, I'm a huge fan of Tom Basso. I think the guy is brilliant. Love all the podcasts you do with him, and I think it's great that you bring that out to all the listeners that don't know who Tom Basso is. But one of the questions that you posed to him that actually came into one of your previous podcasts was, why is it that trend followers seemingly do so well during these black swan events? And if I recall correctly, his response is that in trend following, you are basically following these moves and letting them exhaust themselves. What I think is extremely important is that the trend has already been established in a lot of these cases before the black swan events materialize. The black swan is just this final ferocious push in a market. I sent you a couple of charts just as an illustration, but if we look at some of the major black swan events that we can think of, which we'll even leave 2008 out of this one, but if we look at most recently 2011, which was the U.S. credit downgrade. Now, a lot of people can say there's no way you could have prepared for a U.S. credit downgrade. And that's true because this occurred on Friday night at 8 p.m. when Standard & Poor came out and mentioned this. And that following Monday, the S&P and the Dow were down considerably. But the days leading up to that, specifically the 2nd of August, you saw markets were already breaking down through major moving averages. Well, a trend follower has already spotted the development of that trend and is likely gotten short, where the traditional equity guy may consider making this a purchase or buying on a dip and getting involved in the market, and then they get caught on the opposite side of trade. You can look at those illustrations, by the way, 1987, the same thing. 3 sessions before Black Monday, markets broke down during major averages. 1929, 6 sessions before the crash where we dropped 35%, you had broken down through these same major levels of support. So the trend follower spots that and hopefully gets on the right side and follows that trend to fruition.
We'll go ahead and post some of these charts with your podcast episodes. So people listening now will be able to see these. I think it's, as I was bringing up the volatility index and then quickly dovetailed into Tom, but going back, what you kind of brought it right back in as well, because your volatility index starts to show something interesting and kind of what you just described, which is often in a low volatility time period, trend followers are taking their positions. And then it's the expansion later at the big event where, boom, the big news happens. But that's not, the big news part is not where the trend followers are taking their position.
Yeah, the trend followers have already spotted that. This actually, let me circle back off of global volatility back to the wealth formula for 1 second. But if you are attempting to increase the reasonable return category, you want to try to focus on what the market does, more specifically price and price action and the attempting to capture that price action. So you look at market, you look at price, and price resides within 2 main modalities. You have development, where markets are moving sideways, and then you have distribution. And distribution is that formation of a trend where markets move from one price neighborhood to another. Now, this can be, long term. You can look at this over the series of months. And as soon as you start to get those periods of distribution, or as the equity guys will refer to it, distribution to the downside, accumulation to the upside, but these price movements more specifically, once you break out of that development phase, that's the trend follower's signal to get long or short. Then when the market starts to move and you really get into that distribution phase, that's where these black swan events occur, or that's where volatility goes from low to high. And that's broad-based. That's across individual markets, market sectors, and indices. And that's when you really start to see the trend follower start to make its money.
And, we might want to add, so we're both sounding a little academic there, but essentially what we're saying is that from relatively quiet periods, there starts to be some movement to one direction or another. Maybe not a lot of movement to make the average market participant think this is a signal, but for trend following traders, it is. And so trend following traders get long or short. They're just doing their thing. And then when the quote proverbial blank hits the fan, that's when all the pension funds, whose only strategy with your pension money is to be long only equities, and you pay them billions of dollars in fees for all these pension funds around the world, by the way, then your guys, your government employees that you pay all this money to manage your pension wealth, boom, that's where you get it handed to you because they have no strategy. They're just long.
Yeah, and that's funny. Their hands are tied. It's not that a mutual fund manager or a pension fund manager is any less intelligent than a successful trend follower. It's that by mandate, by charter, they're unable to go flat positions in most cases. They can't go to cash, and they especially can't get short. So to do a good job, they have to lose the least that they can. I jokingly equate that to saying, listen, if you're going to get punched, you have the choice as to get punched either in the face or perhaps on the arm. Just choose which one's going to hurt you the least. Where the trend follower wants to not get punched at all. That's really the difference.
Well, I think also too, the trend following trader not only does, is he looking to cut his losses and avoid the punch, the trend following trader is looking at these dynamic periods, these black swan periods, as a place to profit. It escapes me at this moment in time, but I put it in one of my books. Who was it? It was Ben Stein saying that if you made money in October of 2008, there was something wrong with you.
And he's a smart guy.
Sure.
Which is what's crazy about that. This is a smart man, not recognizing the ability to be able to be profitable from price movement. It's just price. And price action and capturing that price action, which is what differentiates the trend follower from the herd, I believe.
Let me throw a little bit more academic at folks for a second. Why don't you run through the notion of this asymmetrical return stream that's part of the trend following vocabulary? Maybe other people have called it different things over the years. I've heard quite a few trend followers call it just that. But why don't you walk people through, when you sit down and let's say you've got some very bright people in the room and you're initiating them to trend following and maybe they're doctors or attorneys or grad students or whatever. Maybe they got a few dollars, maybe they don't have any money, who knows what, but you're introducing them to the idea of an asymmetrical return stream. Al, the floor is yours. Educate.
Well, I think that the hardest thing for the average investor to grasp is that trend following is going to produce returns the minority of the time, which means the majority of the time you're going to see your equity curve, your own picture of your own money going sideways to down. And that is very frustrating for a lot of people first to understand. I like to refer to trend following as constant aggravation and frustration, followed by brief periods where you potentially make a lot of money fast. That's the asymmetrical nature of trend following. So let's think about that. There are four potential outcomes of a trade. You have the potential to win big, the potential to win a little, the potential to lose a little, and the potential to lose big. Well, the trend followers model is to remove the fourth, which is to lose big on any one particular trade through money management, which leaves you three scenarios: lose little, win little, and win big. So your little winners, which are occurring the minority of the time, are going to kind of chop away at these little losers. And then you're going to catch these one or two major moves in the market that are going to pay for all of those losers and then some. If you look at it statistically, let's use 10 trades and let's look at a win ratio of 40%. You will win 4 of 10 trades, or as I like to explain it to the novice investor, you will lose 6 of 10 trades. That statistic becomes a little bit scary at first. What makes it more difficult to understand is that it's not that 4 of every 10 trades will win. That's your statistical average. So you're going to have periods where the pendulum is going to swing to the left of that statistical mean, and you'll have 2 of 10 trades that will win. And then you'll have periods where the pendulum will swing to the right, and now you're going to have perhaps 6 of 10 trades that will win. And that's what I describe as those periods where you potentially make a lot of money fast, when the pendulum is swung in your favor.
In some ways, I guess if people are just imagining what the chart looks like, it's very exponential looking. It's very parabolic looking. And that could be at a short time frame, but it's a quick upturn. And that can happen very quick with trend following. So there's people might say, well, that's a negative. You have to have this system in place all the time. So you do, because look, I didn't make the world. You didn't make the world out. This is the reality of markets. And if you want to play this particular game and you want to play it right, you got to be prepared for some tiny periods where significant money is made.
Well, you know what? It's even more interesting when you really take a look at this. This happens all the time, and people just don't necessarily recognize it. One example that I like to look at, if we were to go back to January of 2007 to July of 2008, and we were to look at crude oil specifically, just crude oil. Crude oil went from $50 a barrel to $147 a barrel, basically the better part of a $100 movement.
No leverage.
Yeah, no leverage. I'm just talking about just playing the price of oil. Okay? If you were to plot that chart and then draw a line from each high to the next high, you would find that roughly 14 of 18 months of that price move, the price of crude oil went flat to down, and in some cases down 23%. Yet in the 18 months, oil went from 50 to 147. 14 of those 18 months were sideways to down. That's in line with anything.
Let me interject another element of your white paper into this discussion as you talk about that. The size of your position plays a dramatic role in that kind of a scenario, and how you size your position.
Well, you have in trend following, there are 2 real main ways of looking at it. You have fixed contract allocation, and then you have what's called fixed fractional contract allocation. Now, the 2 are very different in position sizing. First, in fixed, you're always going to trade a 1 lot or a 2 lot or a 5 lot or whatever your budget calls for. The second is called fractional contract allocation. And in fractional contract allocation, you are going to be sizing positions based on the market ranges, or the ATR, the average true range of the market. Now, this is extremely important and really helps understand why some trend followers make very large gains over certain periods of times. You can go back and look at some periods like 2008, a very good example for trend following success. What's the difference between a trend follower that made 20 or 30% in that year versus a trend follower that made 70 or 80% or even more in those periods? It's not necessarily that one took substantially greater risk than the other. It's that the period leading up to that was a smaller volatility period, which allows a fractional allocator to increase position size, meaning assume a $100,000 budget, assume a 2% fixed risk mandate on per trade risk. So that means anytime that we take a trade, we're going to risk $2,000. Now, if I'm a fixed contract allocator, I'm only going to trade 1 lot, let's say, and as long as the risk from entry to exit is under $2,000, I'm going to take the trade, but I'm only going to trade 1 lot. Well, if I'm a fixed fractional contract allocator, now I'm still going to adhere to my 2% risk mandate, $2,000, but if the stop loss requires, let's say, $1,000 from entry to exit, I could trade 2 lots. If the stop loss calls for $500 from entry to exit, I can trade 4 contracts and still fit neatly within my 2% mandate. So when the market starts to move and we have this shift from low volatility to high volatility, the fractional contract allocator is rewarded twofold. First, of course, from the directional movement, but second, from the increased position size of 4 units on an expanding range in the market. That's where these rewards are super handsome.
Yeah, and in your white paper, you've got some nice charts in there that show this visually, where people can see that these volatility expansions are highly rewarding.
I think it's important for the person that's trying to develop an allocation to trend following within their overall portfolio to understand the mechanics between the two and trying to build a blend between the two. I'm going to go back to Basso, and he had mentioned something, Mr. Serenity. It's not about what he believes he can handle, but what he believes the investor can handle. And that I think is probably one of the most important things that I've heard him say in the podcast, because if you have a more volatile track record, and sometimes the fixed fractional allocators may be a touch more volatile, they're going to have these 80% winners. They're going to have a 40% winner, but they may go into a drawdown of 30%, of 40%. Now, looking at their longer time frame and looking at their track record over that longer time frame, you're going to see that they may compound, at maybe 20%. Or more, but there's a lot more volatility within that. You yourself said that increasing the reasonable return comes with increasing the risk, where a guy like Tom Basso or a fixed trader might have less of volatility within the drawdown and not have an 80% year, but might have their peak periods might be 20 or 30% as compared to an 80% winner.
So my listening audience, a lot of different types of listeners. We have some folks that are professional traders. We have some folks that want to invest with trend following CTAs, and perhaps many folks who want to try and create or run or use their own system. Your white paper is kind of twofold. So what we've been talking about so far is the system operation, so to speak, how trend following performs, how it performs within volatility, how position sizing affects that, the wealth formula in the beginning. I want to dovetail out of that for a second and go into the idea of how people, investors, those investors that want to invest with trend following traders, the return chasers, the folks that have actually made the decision in their mind that they think trend following is a wise thing to invest in, but the timing of when they invest is an absolute disaster.
Oh, I agreed. The tough thing about it is that it's just human element. Now, this doesn't matter whether we're talking about trend following, but this applies most specifically to trend following, in my opinion. But people love winners. And it doesn't matter whether that's a winning sports team or if it's a real estate market or if it's the tech bubble from the 90s. The song remains the same. People love winners. As such, people start looking at track records, and all of a sudden they see something that performed tremendously. And of course, that's where you want to allocate your dollars. You want to be on the winning performance. But this is a challenge, because when we look at trend following, we remember trend following produces fruit the minority of the time. So in most cases, when people chase that return, they are buying these track records at the heel of an already existing move. So what's going to likely happen in this case is you're going to go sideways to down, which is true to form of any trend following model. You're going to have a period of 6 months or 8 months or whatever the period is where nothing happens, or worse, it goes down in performance. And the hot dollars that chase this track record get soured. They leave only to miss the next run up in trend following. And this is very well illustrated if you look at the Barclay Systematic Index. which is a composite index of 670 some odd systematic traders. That can be loosely described as trend followers. And then you look at money flows, dollars that are being allocated to trend following models, kind of like money that's being added to mutual funds, the flows right there. You can find that right after you have these upticks in the Barclays Systematic Index, meaning positive periods of performance, dollars start flooding in there chasing that return. And they keep adding during that sideways period. And then as soon as you see that uptick in the money flow, it just starts rolling back down because they're not getting the returns, the immediate gratification of which they sought. They start pulling those dollars out, and then you watch the Barclays Systematic Index make its next move up.
Can I say something that sounds a little mean? Who are these idiots that make these decisions decade after decade after decade, the same idiotic decision? Are these mostly pension funds? Is this what we're talking about ultimately? That these folks that just... they've got a sniff that this is something they should be doing for their clients, for the people in the pension funds. They've got a sniff this is the right thing to do, but they have what? They have no training. They have no understanding. I mean, it's not. I mean, look, speaking of Tom Basso, he wrote a report years back about this very issue, and I know there's quite a few trend following traders that'll talk to their clients and talk about buying trend following strategies on the dip, so to speak. How do these guys miss this for so long? We're assuming, as we talked earlier about some of the pension investors, we're assuming these are some smart, astute men and women, probably trained at the best universities under the top professors. How the blank do they keep getting this so wrong?
It's patience, and that's the hardest thing. When I talk to people about trend following, I tell them one of the most.
That was a politically correct answer right there. By the way,
it was well. Hang on. True, that's correct.
Okay, you don't want to call them idiots. I, as the host of the show, I have to call them idiots, and you're the nice guy. Okay, so they won't come back out and say Al said something mean. They can just say the crazy guy Covel said something. Okay, fair enough.
That's funny. The fact is look, when I talk to people about trend following, I explain to them point blank, one of the most difficult things that's going to face you in trend following is you yourself, because you're not going to believe that it works. It's difficult to do something that you've done different your entire life. You've owned stock, you've expected things to go up, and you've wanted to see, the markets move and get some kind of return stream. It's especially difficult for trend followers when you look at markets like last year, where the stock market was just roaring. So you got a 30% plus charge in the S&P, and you've got flat performance in the Barclays Systematic Index. And people say, well, this was a humongous move up. How come this trend follower didn't make money? Or how come that trend follower didn't make money? And it's got nothing to do with the stock markets. It's got to do with just trends that materialize around the globe. So when you look at your monthly statements as a client, or whether you're a pension fund or a doctor, doesn't matter, and anything in between, you're just going to look at that bottom line. And when you see flat to sideways performance for 4 months, 6 months, you immediately think, boy, this doesn't work. And somebody else is in your ear saying, but I just bought the stock and it went up, twofold. And, I bought this house and I flipped it right away. And I did this and I did that. And I made all these returns. So you get impatient, and those impatient dollars chase return, hence the sucker's game.
Al, I want to add in there, though, too, that in 2013, without naming names, there were some very, very fine trend following performances right there on a par with just long-only equity indexes. I think one thing it's worth pointing out to a listener out there is that you really have to do some homework about who are the other investors. If you're somebody that wants to invest with a manager, who are the other investors with a manager? Because you know what? Many managers these days change programs almost in a not so positive way to appeal and land investors. So there are trend following programs out there that, frankly, the advisors, the managers, the traders are making decisions that they know are not the best decisions necessarily in terms of how the strategy is implemented, but they do so because that keeps clients happy. Clients drive a lot of bad decisions on trend following, whether it's the allocations or just keeping them in the fund.
Yeah, and that's I think that's a massive mistake that's being made. When I think a person looks at trend following, like you said, I believe what they need to look at is not just necessarily the other investors in the fund, but the methodology that is being used. So forget about performance. There's nothing to talk about in performance. If you have a winning year, you have a winning year, and period. There's nothing to talk about. It's the drawdown period. I think that when analyzing anybody's performance, the most important thing for me, and I think for everyone, should be, let's look at the drawdown period. Let's look at how the market fared during that drawdown period. And let's look at what the strategy was used. In other words, on the fixed fractional trader, are they violating their risk mandate? Are they, increasing position sizes outside of that equity, that equity meaning per trade risk exposure? What's the win-loss ratio look like? Going back to Basso, they asked him a question, how do you know something still works, or how do you know when to call it quits in a drawdown? And analyzing what the system is doing during the current market conditions, if it stays within line, that's perfect. So as an example, if you look at, let's say, a trend follower that has, a 25% drawdown over, let's call it 16 months. What you want to do is you want to go into that drawdown and take a look at the win-loss ratios over that 16 months. What's the trade accuracy? What was the dollars made versus the dollars lost during that 16 month? And then, if that stays within line of everything else, that's part of that track record, that's a good sign. Now, go and look at the recovery period. So what I do, and what I think others should look at, is benchmark the recovery period versus the drawdown period. So here you have, let's say, a 16-month drawdown of 24%, and it's followed by a 5-month recovery period. That's a good model. You go back and then look at the other drawdown periods of the same manager, and do you see the same characteristics? Do you see the same drawdown statistics lying within the win-loss ratio and the trade accuracies? If so, that means the model isn't changed. They're not trying to appease a larger investor, as you've just pointed out. They're not trying to be adaptive to a period, because that's how you ruin the viability of your model.
All great points. Alice, we've covered a lot of territory today, and I think people are going to enjoy digging into your paper. I will post that with the podcast episode so everyone can see it quickly, easily, so they will be able to kind of be looking at it while they're listening to us talk. Is there anything, I think we covered most of the key areas, but where is the best place for people to reach out and contact you if they have more questions, they want to offer some insight, they want to come fight you? Where can they go? Do you take fights from people? Do you just, you're just a decent sized guy, so I guess if they come to punch you, they better be prepared.
Well, I've run pretty fast too, so they're going to have to catch me, number one. But all kidding aside, I do welcome comments, both good and bad. I know that I don't know a lot of things. So someone that's out there that has a viable point, I'm a student every day, and I'm also willing to expand on any of the points that we've talked about, which, we've covered a lot, but you can go into, as you know, a lot greater detail on any of the subject matter we discussed in this short podcast. A great way to contact me is through email, al@kingsview.com, kingsview.com, and I'll respond to all emails from there.
Cool. Al, take care. I appreciate you taking the time today, and I think it was quite fun, and I think people will learn and enjoy it.
Thank you, Michael. Great talking with you.
We will talk again soon. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced,
college student or financial advisor, protecting against a crash, or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.